I'm Joe Patton, the section chair for our conservatorship, guardianship, and protective proceedings section. I have the privilege to introduce our speakers today. First, a few announcements. The MCLE sign-in and certificate to be eligible to receive all 1 hour of CLE credits for this program. All attendees must sign in on the registration sheet by 12:40 p.m. Please make sure your cell phones are silenced, and please complete our evaluation forms at the end of the program and turn them in before you leave. So I will introduce now our presenters. First, Mr. Pete Tintler, a certified reverse mortgage professional with Independence Reverse Mortgages, and Megan Boctaderi, attorney at Treadway, Lumsday, and Doyle, will be our presenters. So take it away.
You know, I would never recommend a reverse mortgage to my clients. A reverse mortgage is really a scam. And you should only recommend a reverse mortgage or consider a reverse mortgage as an option of last resort. So I've heard this for the last 20 years. I've heard this from people, professional advisors. I heard it last week. So all these years that reverse mortgages has been around, there's still this stigma that reverse mortgage is a scam and you're going to lose the house when you die. Well, newsflash, when you die, you're going to lose everything, right? So before I tell you how wonderful reverse mortgages are, because I've been in the industry for over 25 years, what I want to tell you is addressing the myths and misconceptions about reverse mortgages. We'll get to the agenda later. I'm not going to bore you with that. I was playing in a golf tournament many years ago, and after the tournament, my opponent and I met up in the lounge, and I was going to buy him a Kool-Aid because I won. And he points up to the TV and he says, "There's a reverse mortgage commercial on the television." And he looks at me and goes, "That is the biggest scam there is out there." Now, keep in mind, this was a tournament. We're having friendly, good shot, but we're not talking about each other. We don't know each other. So I didn't know what profession he's in. He doesn't know what profession I'm in. And I said, "Well, if you think it's a scam, can you tell me how does a reverse mortgage work?" He's like, "It's pretty simple. That the house has to be free and clear. No mortgages, no liens, nothing." Okay. So what happens next is you sign the house over to the lender. The lender in turn pays you a monthly mortgage payment, but when you die, the lender keeps the house and all the remaining equity. I said, "Okay, that's interesting." I go, "Can you mind if I want to explain to you how it works?" And I was very delicate about it. I didn't want to insult him. I didn't want to humiliate him. Reverse mortgages come across your desk once every 4 or 5 years. I don't know. I was talking to Megan. She says that reverse mortgage came across her desk twice in the last 7 years. So how am I expecting you or yourself to be experts on reverse mortgages when it doesn't come across your desk that often? So when I explained to him that, first of all, the house does not need to be free and clear. Many times people turn to me and they say, "If you just get rid of the mortgage payment, we have enough cash flow to survive. We don't need any other additional money. Just get rid of our mortgage payment and we're good." Second, and this is very important, you always retain title to the home. Contrary to the belief, you're not signing the home over to the lender. And as far as the monthly payments go, that's your option. So you have and we're going to get into this a little bit more later about getting a monthly payment or a lump sum, etc. So that means that when you have the option of selling the home at any time, or your heirs have the option of selling the home, and they're going to keep all the remaining equity. So I said, "Does that make sense to you?" And he goes, I guess so, but I could tell he was very uncomfortable. And I said, again, that's the last thing I want to do is make you feel uncomfortable about asking questions about reverse mortgages. And I said, "Is there something wrong?" And he says, "Well, I wish I knew about this before." And I said, "Well, before what?" He goes, "Well, about 5 or 6 years ago, my client asked me about a reverse mortgage." And I said, "You're not going to qualify. You have a mortgage balance. The home has to be free and clear." I go, "Okay, so you gave him the wrong advice. What's wrong with that?" And he goes, he says, "About 2 years later, they lost their house to a foreclosure." Now, he kept saying client. I didn't realize. I go, "So Larry, what is it you do for a living?" Larry was an estate planning attorney with over 35 years of experience. So he gave the wrong information to the client, and it cost the client his home dearly. bottom line is again, this doesn't come across your desk that frequently, so I don't expect you to be experts on it. But even furthermore, Larry admitted a little bit later that he was too embarrassed to admit that he didn't understand how it worked. He figured because he's an attorney, he should know about everything. That's not true. So my agenda that I wanted to address these issues first. The agenda here is, first, what I want is when you leave here, you've debunked all these myths or misconceptions. Number two would be you're going to understand many different applications of a reverse mortgage that you may not have thought of before. And most importantly is that if you have any questions about reverse mortgages, if you don't have a professional reverse mortgage advisor, I'm always available for your questions. Okay. And when you call me with these questions, you're never going to hear me say, that's a silly question. You're never going to hear me say, I covered that already. And you're never going to hear me say, well, everybody knows that. Why are you asking me that silly question? I'm available for any questions anytime. I'm going to go a little bit further into that. A few years ago, there was a gentleman in San Diego, top attorney, and he calls me up and he says, hey, Pete, I'm sorry, this isn't a referral. Okay, Steve, what's up? Because my client mother just passed away. She had a reverse mortgage on her home, and now they're getting these letters from the lender saying if we don't pay it back within a certain time, they're going to foreclose. And I've seen these letters from HUD, and they're not gentle letters. They're very harsh, and somebody just lost a loved one, and it's just like, boom, you don't pay us, you don't contact us, we will foreclose. It's not a pretty lender. So I said, Steve, this is what happens. You do this, contact this person. I walked him through the entire steps of everything. And after about 10 or 15 minutes, he's like, but that's a lot more information than I expected. Send me an invoice for your time and I'll pay you. I said, Steve, I'm not an attorney. I don't bill by the hour. I just bill by the transaction. It's like, well, how are you going to get paid? How am I going to compensate you? I'm like, Steve, you're one of the top attorneys in San Diego County, and you're calling me for advice. My head's like this big right now. So always happy to take your calls, no matter what they are. There's no silly questions ever. Other misconceptions about the reverse mortgage is that when you draw money off the line, you have to pay income tax. This is a tax-free loan. Okay, just like a regular home equity loan. So this would be somebody that the financial planner would say something, well, I understand the reverse mortgage. We'll call you when we run out of money, when we deplete the retirement account. Well, why would you do that? As you're depleting that retirement account, you're having to pay some type of tax, income tax or capital gains tax, where I can provide the client a stream of income, whether it's eliminating a mortgage payment or having a standby line of credit or a monthly stipend, tax-free. What makes more sense? The other misconception is that a reverse mortgage is usually only for poor people. I'm going to demonstrate why it's not a little bit later in the program. And then again, a reverse mortgage should only be considered as an option of last resort. As I debunk that with the financial planner, I'm going to debunk that further in greater detail. That's going to, a lot of people are going to say that's interesting. We didn't know about that. Any questions so far? I know I'm throwing a lot of information at you at once. Yes. Okay, so the question was, 20 years ago, there was a problem with fraud. Okay, great question. Thank you. So reverse mortgages go back to the 1960s. It wasn't until 1988 when Ronald Reagan regulated that with HUD. So from 1967 to 1987, there were private reverse mortgage lenders out there saying that when you die, we get the house. So it wasn't necessarily fraud, but if you're referring to fraud with the HUD interaction, the borrower, every applicant must go through a counseling session. It's a telephone counseling session. I provide the borrower with a list of HUD approved counselors. They can have anybody on that phone conversation with them, their lawyer, the financial planner, their siblings. The only person they can't have on that phone call is me. because they're afraid that I'm going to be steering them through the guidelines of that. So to answer your question about fraud, I think that was the main thing that was done. But thank you. Very, very good question. The next is eligibility. So the eligibility, the age requirement, the age requirement is 62, and in some cases, the age requirement is only 55. And I'm going to describe that in a moment. The two different types of reverse mortgage. It must be the borrower's primary residence. The reverse mortgage has to be in first position. And I do have a lender right now that I partner with that is offering a reverse mortgage that's going to be in second position. That's rare, and it's rarely new. Began February, and they brought that in because there's a lot of people out there that are over the age of 62 that just refinanced their mortgage for under 3%. So why would I get rid of my 2 3/4 interest rate, but I need cash, but I may not qualify for a HELOC? So that's where the reverse mortgage second position comes in. If we have time, we'll get into that a little bit later. There's also eligibility for the property. Again, primary residence. In some cases, if it's a condominium, it has to be FHA approved, which is usually fairly easy. And to cut to the chase, the eligible properties, we can do a reverse mortgage on a manufactured home. Okay. A lot of people ask about that, but then beyond that, underneath that, there's a whole litany of requirements. They have to own the land. They could never have been moved from the original site, and so on and so forth. So other ineligible properties will be things like dome homes, log cabins, and believe it or not, in the guidelines, it says igloos, no igloos. And then finally, the eligibility is that, as we just spoke with this woman here about the financial assessment. The financial assessment, when I got into the reverse mortgage business 25 years ago, they didn't care about the credit. They didn't care about income. If you were in bankruptcy, they didn't care. Well, today, as of 2015, they are now doing a financial assessment to make sure that the borrower still has the ability to pay their property taxes, property insurance, and HOA. Now, keep in mind, with a reverse mortgage, there's no mortgage payments required, unlike a traditional mortgage. So it's a lot easier to qualify for a reverse mortgage with people that have less income. And if you're in California, if you've been in that property a long time, along with Prop 13, the property taxes are fairly low, so it's a lot easier to qualify. Compare that to the state of Illinois. My parents bought a home in 1962 for $50,000, a suburb of Chicago. And when my siblings and I sold that home in 2016, after my mother passed away, the property taxes were $22,000 a year. So doing a reverse mortgage there would be a lot more difficult than here in California. So here are the disbursement options that I talked about briefly earlier. You have many different options. You have the option of a lump sum. Again, a lump sum would probably be ideal if the borrower had a large mortgage. So if they qualify for, say, a $400,000 loan and their mortgage balance was $400,000 or $385,000, the obvious choice would be the lump sum. The lump sum is a fixed rate. However, if their home is free and clear or near free and clear, then the option I would highly recommend would be the credit line, meaning that they only borrow on what they need. They may have a $100,000 mortgage, so we pay off that $100,000 mortgage, and then there'd be $300,000 left over on the credit line that they borrow as they need it. And then you have the option of getting a monthly payment. The monthly payment can be done as what we call a tenure, meaning that based on your age, we can give you this amount of money for the rest of your life. No matter how long you live, you could live to 106, 110, you're still getting that monthly payment regardless of the mortgage balance. Or you can say, I just need to borrow money for another 2 years. So when I turn 70 and a half, okay, 70 and a half is when you can push your Social Security income out to that. So if you do it, wait until 70 and a half, your Social Security income increases about 8% a year. But they say, we're 67, we need that money now. Okay, so let's set it up where we draw $800 a month or $500 a month, whatever that number is. and we'll do it for the next 3 years. And then we turn it off and the rest goes on the credit line. So it's real flexible. You can have this set up where you get a lump sum, you get a credit line, you get a lump sum or a credit line. And then the credit line, you can use a standby line of credit. You can say, I want money for the rest of my life, or I want money for a short period of time. And in some cases, and I'll explain to you in a moment, where the credit line might be something you just say, I don't want to borrow any money on the credit line, but I want to establish it today so I have money in the future. Okay. Let me get in that in just a moment. But the bottom line is that it's a very flexible tool for your clients. Okay, again, I'm feeding a lot of information at you. Anybody have any questions so far? So if I had a quiz on this, you guys would pass it. So what happens when the borrower dies? Anybody know? Who gets a house? Goes to the heirs. Yep. Okay, good. Good. Got to pay attention. So now there's two different types of reverse mortgages. You have the FHA insured home equity conversion mortgage, reverse mortgage. And then you have what's called we call the proprietary, also known as a jumbo reverse mortgage. Now the proprietary reverse mortgage is that lender's own reverse mortgage guidelines. So a year ago, there were 7 lenders that had their own private investor reverse mortgage. Now we're down to 3. So let me quickly give you the guideline. The FHA HECM, that stands for Home Equity Conversion Mortgage. Okay, that's just type of reverse mortgage. The difference between the two is that the FHA reverse mortgage limits your home value to $1,089,300. So if your client's home is worth 1.1 or more, they're only going to get a percentage of $1,089,300. Whereas the proprietary, they don't really necessarily have a limit on the value of the home. They have a limit on the loan amount. And the proprietary lender can go up to $6 million. The FHA reverse mortgage, the minimum age is 62, where the proprietary is 55. The closing cost on an FHA reverse mortgage is more expensive than the proprietary reverse mortgage. Loan to value percentage on the FHA is greater than the proprietary. And then the growth rate, we'll get into that in a moment. The growth rate on a reverse mortgage is considerably better than the proprietary. I know I got a lot of looks on this one, but we'll get into this in a moment. All right, so what's the difference between a home equity conversion mortgage and a HELOC, a home equity line of credit? Because sometimes people say, why don't we just get a home equity line of credit? Okay. Here's the main reason. There's a woman up in Uplands, California, several years ago, big house, beautiful house, garden, everything. House was worth about $650,000. It's probably worth more than $1 million today, even in Uplands. She had a small first mortgage, but that first mortgage had a very high interest rate for the time. It's like 8%. So she had a high mortgage payment. Her recently deceased husband left her a gift of $75,000 in credit card debt that she didn't know about. So now she's got $75,000 in credit card payments, high mortgage payment, Social Security. She goes to her local bank and says, I've got all this equity in this home. I've got $500,000 equity in my home. Can I get a home equity loan to consolidate all this debt? And they said, the calculations are like, you only qualify for $35,000 because she has to make that mortgage payment. So what we call the debt to income ratio, what is your debt amount to the income that you're bringing in? So it was very difficult. She couldn't get it done. Her financial planner called me and said, Gina's plowing through her retirement account. And if she doesn't do something, sell the house or get a reverse mortgage, she's going to be out of money in about 2 years. So I came in, assessed the whole situation, was able to pay off the first mortgage, pay off the $75,000 in credit, what was left over was going to be a credit line of about $185,000, if I recall. And she says, you know, for the next 2 years, I want to get an additional $500 a month. So, and that came, it's just like, this is how the reverse mortgage, again, there's no mortgage payments required. So it was a lot easier for her to qualify. They just need to demonstrate that she could pay her property taxes, which were nothing. I think it was like $800 a year, and her homeowner's insurance. And now she's got this home, no more mortgage payments, no more credit card debt. And what she said to me, she said at the closing, she kind of got all teared up and said, you know, I had all this equity in this house and it was all locked up and I couldn't get access to it. And I really thought I was going to have to lose this house, have to sell this house. And a big smile came across her face. She's like, you're like a locksmith. You unlocked that equity in my home. So that's where I came up with can't see it here, the financial locksmith. So the difference between the home equity line of credit and the reverse mortgage, you have the debt to income ratio, because on the HELOC, you're going to have to make mortgage payments. You have to demonstrate that you have more income coming in. The loan amount is based on your income on a HELOC, whereas the reverse mortgage, it's based on your age. So the older you are, the greater the loan to value percentage you can lend. There is no term on the reverse mortgage, whereas the HELOC has a 10-year term. So after 10 years, if you wanted to draw money on that credit line, you have to reapply, you have to refinance. And typically what happens with people in retirement, 10 years later, their income hasn't increased that much, but their debt has. So now their debt to income ratio is higher. They may qualify for less money than what they originally got 10 years earlier. So on the reverse mortgage, that credit line is good for as long as they are still living in the home and continuing with the covenants of the loan, which is paying your property taxes and your property insurance. The big difference there is that we remember 2008, March of 2020, beginning of the pandemic, when the housing market starts to become volatile, when the housing market goes down, when the equity markets, like March of 2020, start to go, volatile, get wonky, lenders get worried. So a lot of people had a credit line, a home equity line of credit back then, that suddenly the bank says, we're going to freeze your credit line until we see the end of this. Not a big deal, right? Buddy of mine had a HELOC and he called me in a panic. This is back in 2008. He goes, they just froze my credit line. I guess, all right, Sam, what's the problem? You kind of knew that was probably going to happen, because I was going to use this $100,000 credit line to remodel my kitchen. I go, well, you're going to have to put that off for a while, right? He goes, I just gutted it. I gutted my entire kitchen, and now I don't have the money for this. He ended up having to sell some investment stocks to pay for it. So his $75,000 kitchen ended up costing him $95,000 with income tax that he had to sell from the investments. So no matter what happens with the FHA reverse mortgage, with your home value or the equity markets, that credit line will never be suspended. That's unheard of on any other HELOC. It will never be suspended. Another very interesting feature with the FHA reverse mortgage that's not found on the HELOC is that that credit line is going to increase every month at the same rate as the interest rate. I'm going to go into further detail on that in just a moment. The FHA reverse mortgage is a non-recourse loan. Non-recourse means that the borrower and their heirs will never owe more than what the house is worth. So let's use a perfect storm. On day one, a 62-year-old gets a lump sum of $400,000. They max out everything they got. They take it on day one, and they live for a very long time. We hope they do. The credit line, the mortgage balance is going to continue to increase, right? Because there's no mortgage payments. Interest accrues, and the perfect storm is we have another housing crash of like 2008. So suddenly they're 92 years old. They owe $1 million on their credit line, and the house is worth $900,000. What happens next? Does anyone know? Anyone want to guess? Wash? Wash what? So they kick them out of the house. It's a non-recourse loan. You're exactly right. So no matter what happens with the balance of the loan, they still get to stay in the home. The title is still in their name. Now, what happens when they die and they're underwater? So the heirs, the heirs inherit the home, and the lender says, you owe $1 million. The loan balance is $1 million, but the house is only worth 900. So the heirs have an option of walking away unscathed. The loan's not in their name, or they have the option of buying the home of 95% of current market value. So 95% of 900,000. I haven't seen that yet in my lifetime because I'm on the origination side, not on the post-funding side. But that's a good to know, that people think that the heirs are on the hook for that delta. That's not true at all. So that's a whole idea between the non-recourse. Whereas your typical HELOC, if you go default on your mortgage payments, they can foreclose. So the HELOC's a great idea. The reverse mortgage is a great idea. Both have their places. Sometimes the HELOC is better than the reverse mortgage and vice versa. And again, that's something where you have any questions about that, which one is better, pick up the phone, give me a call if you don't have somebody already, and I'll be happy to explain that to you. Yes, sir. Okay, so the loan becomes due. The loan becomes due. There's no term on a reverse mortgage. Okay, technically there is. If you look deep down in the paperwork, it says the loan becomes due on this date, and that date is the borrower's birthday of 150. So there is really no term, but as long as they're living in the home and keeping up with the taxes and insurance, no mortgage payments are due. The loan becomes due when the last borrower permanently moves out of the home. Okay, so wife and husband were living there. I pass away. She continues living in the home. And when she sells the home, that's when the loan becomes due. When she permanently moves out of the house, she moves into assisted living, the loan becomes due, or she dies. Okay, so the question was, after the last borrower dies, how long do the heirs have to pay off the reverse mortgage? It's a two-part question. So the answer is 6 months. They have 6 months to repay the reverse mortgage, but the lender, given certain circumstances, will allow 2 90-day extensions. So a good example would be, it's a soft market. We're in a down market. It's hard to sell a home. Nobody's buying. And as long as you're keeping communication with the lender saying, this is what we're doing to market the house. And they say, we understand, everyone knows it's a soft market. We'll grant you another 90 days and another 90 days. Now, keep in mind, as long as that loan is open, interest still accrues even after the borrower dies. So it's in the best interest of the heirs to get that loan paid off as soon as possible. And you can pay it off with, you have cash in the bank, or you're going to get a mortgage, or you're going to sell the home. Either way, within 30 days of the death of the parent, I'm assuming, notify the lender within 30 days and give them your intentions on how you're repaying the loan. Okay. Does that answer your question? Anybody have any questions about that? So you have 6 months to repay the loan with an additional 2 90-day extensions upon approval, which, why would they not give you those extensions? Is if you're squatting on the property, if you're trying to rent it out and double dip, and if you're not communicating with the lender, or if you're saying, we're going to try to sell the house ourselves and save ourselves a realtor's commission. We have the house listed for 900,000, but everybody knows it's worth 800. Eventually the lender's going to say, all right, all bets are off and we are going to foreclose, which, by the way, the foreclosure process begins immediately. So they will file a notice of default, but they don't want the house. They don't want to foreclose. They want to work with you. So as long as it is open communication, everything should be fine. But a great question. Thank you. Anybody else? All right. Uh, So I said earlier, myth number 5, and there's really like 14 myths that I have. Today, I just give you the top 5. We don't have that much time. You should only consider a reverse mortgage as an option of last resort. And those answers would be, well, we don't need money now. We may run, we'll call you when we run out of money. Or I know I'm going to run out of money in X amount of years. I'll call you then. So earlier, I talked about the credit line growth rate. The available credit line will increase at the current interest rate. Okay, so why would you do this now as opposed to later? So here's why. First of all, the reverse mortgage loan to value percentage is based on the borrower's age. I talked about that briefly. The older the borrower, the greater the loan to value percentage. But in this case, here you have a 62-year-old, home is worth just north of $1 million. They have a line of credit of $409,000. And we have a growth rate right now of almost 7%. So it's 6.78%. So if any of you heard of the rules of 72, anyone know what that means? So the rules of 72 is that if your interest rate is 10%, every 7 years, your credit line is going to double, or your balance is going to double. So in this case, it's almost the opposite. It's in reverse. If you want to add pun to that, the interest rate is 7%. So every 10 years, the credit line is going to double. So here we have a credit line of 409,000. In 10 years, there's 72. The credit line is 715,000. They didn't do anything. All they paid for out of pocket was an appraisal fee and a counseling fee of no more than $200. And you, the advisor, came up with this idea that they set this credit line up that's going to double every 10 years. At age 85, in 20 years, when they're 82, the credit line is 1.2 million. And at the age of 85, the credit line is almost 1.5 million. Now remember, this is an FHA insured non-recourse loan. Regardless of the balance, they still have access to that credit line. So their home value might be $1 million. They still have access to that full 1.5 million at 85. And I say 85 because when my parents were 85, they needed full-time in-home care, which back in the state of Illinois, it's not as regulated as it is in California. They found somebody from the church, this couple that we let them live in the attic for free, had full bath, everything, full suite, and it was $5,000 a month. What is it in California? How much? 25,000. Yeah. Yeah. So when somebody says, we'll call you when we're running out of money in our 80s or 85, that number is going to be completely different. I'm going to cut to the chase here on this one. So here they're 82. They have a higher starting amount because they're older. So their starting amount is 570,000. But look at what happens when they're 85. It's only 673,000. Compared to if they started at age 62, look at the difference here. So again, that myth number 5 that I brought up is use this as an option of last resort. You've exhausted all your income, all your savings, and you do this at age 82. You're leaving $900,000 on the table. Any questions? Yes. So let me make sure I understand your question is the interest. Oh, so you want to know what the closing cost fees were? Okay, I don't have those on there, but on the FHA reverse mortgage, the closing costs, you can have your typical closing cost of title, escrow, et cetera. So let's just call that $3,000. Okay. It's a good faith estimate. It could be 3,200, could be 2,800. We all know that. The FHA has an upfront mortgage insurance premium like the FHA forward mortgage, which is 1 3/4. The FHA HECM, the reverse mortgage, is 2%. So if they have $1 million home, the upfront mortgage insurance premium is $20,000. You have $20,000 plus third-party closing costs of $3,000. And depending on who your mortgage broker is, he may charge a loan origination fee as much as $6,000. I try not to charge an origination fee, especially if they're drawing money at closing. It's just not, I can't do it. It's just not in my nature. So so the question is the closing costs. Let's just say on $1 million home, let's just say the closing costs are $25,000, $27,000. Interest will start accruing on that $27,000. Okay. So yes, the mortgage balance is growing, but in comparison to what they're getting down the road, that's not even a speeding ticket, in my opinion. What are your thoughts? No. It's
What are the additional fees that they're paying by holding in?
no, that's an absolute, that's a legitimate question. That is a perfect question. So people get put off when they see that 2%. So like, I got 20,000 on my $1 million home. I got a $20,000 closing costs. Yes, but we're going to finance that onto the loan. So that eases it a little bit. But once I demonstrate that the credit line growth rate is so much, that you say that doesn't pencil with us. I still get backlash from it, but when they see the bigger picture, this is nothing. Now I'll show you here in a second that when should you not do a reverse mortgage? You shouldn't do a reverse mortgage if you're planning on only using this as short term. So a few years ago, I had this gentleman call me. His house was free and clear. It's about $800,000 home, and he says, "I'm calling to talk about a reverse mortgage. I got a quote from your competitor." I'm like, "Great. Here's what we can do. House is free and clear. This is the loan. I recommend the credit line. So you borrow on it as you need it." He goes, "Well, the other guy offered a fixed rate. I can give you a fixed rate, but the fixed rate's going to be a lump sum. Meaning you're really not taking 100% of that 400,000. You're taking 60% of that 400,000. You have no credit line." And I go, do you need the money right now? And he goes, "Well, really," and this is the power of asking questions. They can use the money for whatever they want. But I asked just so I know that they're not, make sure that somebody's trying to rip them off. And he said, "Well, I want to borrow $50,000 to $75,000, fix up my house and put it on the market within 6 months." And you got a quote from my competitor? Yeah. And they're recommending a fixed rate. Well, the loan officer makes a lot of money when it's a lump sum fixed rate. They go, "I don't think a reverse mortgage is good for you at all. You're better off going to your bank or your credit union, getting a home equity line of credit. Your closing costs are going to be next to nothing. You're going to pay it off within a year. And they may charge you a prepayment penalty of $500 or maybe $1,000. I haven't checked in a long time, but that's going to be nothing compared to the $25,000 in closing costs. I'll get you the 75 grand, but you're going to be paying back 95 to 100 grand." And he said, "Okay, thank you for being honest with me. When I'm done, I'm going to go and buy a house across town for $500,000 all cash, and then I'll get a home equity loan, a reverse mortgage on that." And I said, not too fast. So running out of time. So we covered all that. So which one is best for your client? So you have the reverse mortgage, you have the proprietary, and you have the HELOC. Well, the general reverse mortgage you're going to have higher closing costs. You're going to have a much lower rate. You're going to have a much greater loan to value percentage, but you're limited to a value of $1,089,000. I'm doing one for a client right now, Huntington Beach. His house is going to be worth 1.8 million. We're going to do the FHA reverse mortgage. His house is free and clear. Why are we doing this instead of the proprietary that he can get more money? He doesn't need any money now. But he says, I'm going to need money when I turn 87 in 7 years from now. So let's put it on the reverse mortgage credit line. And in 7 years from now, that credit line is going to not quite double, but it's going to be much higher for you to retire on. And you want to think about the proprietary reverse mortgage. If your home is worth north of 1.25 million, anything less than that, the FHA is a better deal. There's not that many options available on the proprietary. Not all of them offer a credit line. And if they do, that credit line has a growth rate of 1.5%, but only for 7 years. And after 10 years, that credit line closes. So this wasn't good for this guy in Huntington Beach. He was much better off with the FHA reverse mortgage because that credit line is going to be good forever. The problem with the proprietary is they can close the credit line if they're not comfortable with the housing market. As I said earlier, there used to be 7 reverse mortgage lenders that offered their own private investor, their own proprietary. Now there's 3. One filed Chapter 11. The other 3, their investors said, we're backing off. We don't want to lend any money. So now there's 3 lenders left. So a year ago, when there were 7, there was a lot of competition. Rates were low, loan to value percentages were high. Now that there's only 3, rates are high, loan to values are low. Has anybody heard of the golden rule? Because there's only 3 competitors instead of 7. He who has the gold makes the rules. So they got together and they said, we're going to, because we run it. Ooh, look at the time. And then again, the HELOC is probably your best if you're looking for short-term borrowing and much lower closing costs. So, so this gentleman who just spoke about that, I said, get a HELOC instead of a reverse mortgage to do your home improvements and then move. And he's going to go buy a home for $500,000 with all cash because he's got it. Instead of him paying all cash for a home, let's use a reverse mortgage to finance the purchase of the home. So instead of him putting down $500,000 on a $500,000 home, he was probably going to put down a little over 200, 225 based on his age, and the rest is financed with a reverse mortgage. So now he's got that much more money in his pocket. This is why a lot of empty nesters are not downsizing, because they sometimes they don't have enough money to buy a home all cash. So just before the pandemic, there was a couple down in San Diego, Poway. They wanted to retire. They were in their early 70s, but they still had a big mortgage on their home. Their home was worth $800,000, had a mortgage balance of close to $500,000. So when they sold the home, they were going to net $300,000. Where are you going to buy a home in San Diego County or Orange County for $300,000 in 2002 or 2022? Just not going to happen. So they started looking at homes up in the Inland Empire, a place called the Oasis in Menifee Lakes. It's a very nice gated community. They could probably buy a home close to $300,000 in that area. But now they're 65 miles away from their friends, their family members. And they realized, they just said, we're just not going to retire. There's no way, if we downsize, we're going to be compromising our living situation. Maybe they can find a home in inland San Diego County, but it's going to be hot. It's going to be a small home. Just not going to happen. So their CPA referred me in, and I got together with the CPA, the husband, the wife, the daughter, the son-in-law, and I showed to them how a reverse mortgage can be used to finance the purchase of the home. So with that $300,000 down, they were able to buy a home for close to $600,000. They ended up getting a home for like $550,000. The daughter, Jen, is in her mid-30s, early 30s, a couple of kids, said, I've heard bad things about reverse mortgages. Now that you've explained everything, I got to ask, what's the catch? It's too good to be true. You're telling me my parents can buy a home just up the road in San Diego, up to 15 for $575,000, and they're not going to have any more mortgage payment for the rest of their life? What's the catch? I go, the catch is this, Jen, because there's no mortgage payments required on a reverse mortgage. Instead of the balance going down like a traditional mortgage, the mortgage balance goes up. The mortgage balance goes in reverse. That's why we call it a reverse mortgage. So if you're counting on that home for inheritance, then maybe they should be moving up to Menifee Lakes to the Oasis. Again, nice area. I have no problem with that. And Jen said, we don't need the inheritance. What we need are babysitters. My husband and I need a date night. We go out with our friends. We go out to concerts. We get to sleep in on Sunday morning. My parents pick them up Saturday morning, drop them off Sunday afternoon. We barbecue, we watch Disney movies, and all is right in the world. And we recharge our batteries. Our kids get to learn about my parents' generation, and it's great. How soon can you get this done? So real quickly here is I invited myself to their new home about 3 months after they settled in, just up the road in Seven Oaks and Rancho Bernardo, right off the golf course. Beautiful home. 3-bedroom. Second bedroom was a den. The other bedroom was the bunk beds for the grandsons. And it was really hard with them in the beginning. The wife was not on board, but she was suddenly very, very happy. And they said, you know, this house was just the right size. And the other one said, and we didn't have to compromise on our living situation. So what I like to call about a reverse mortgage for purchase is that you're able to right size without compromise. All right, so we're just about wrapped up. I told you I could talk long. So just to wrap up, remember, it's a very useful tool. And again, it's not for everybody, but to know that you have the options of the lump sum, the credit line, the reverse mortgage for purchase. It's FHA insured. It's a non-recourse loan, and everybody has to go through some type of counseling session, and they can have everybody on that counseling session except for me, because so I don't try to, the counselor's there to make sure they understand what the negative amortization loan is, that's what a reverse mortgage is. But they're also there to make sure I'm not ripping them off. So back to the very beginning about the golf opponent that I had. You're never going to hear me say there's a silly question. You'll never hear me say I've explained that to you already. And you'll never hear me say everybody knows that. So with that being said, it's my phone, my email, everything, any questions, anytime. Does anybody have any questions at this point? Thank you.
Thank you, everyone, for attending. And again, thank you to our presenters, Pete and Megan, for being here today.